Hi, folks, and welcome to today's webinar, Preparing for the What Ifs of Life and Maintaining Your Financial Wellbeing. Jim Stapleton is my name from Olus Money, and I'm delighted to present to you today. Just to give you a little bit of a background on Olus Money, Brendan and I, we established the practice in 2009 as a financial planning and wellbeing practice, mainly to enhance the financial wellbeing of our clients, whether they be companies, individuals or families, through education, information and knowledge sharing. Some of you may know that OLUS is the Irish for information or knowledge. Also, we wanted to help our clients navigate their financial journey through life. Okay, some of the services that we provide as a financial planning practice, cash flow modeling, tax returns, insurance, etc., and financial well-being seminars and webinars on various topics. So today, protecting against the what ifs of life. Okay, so in terms of what is financial well-being, when we're working with our clients, we break that down into four distinct areas where you and your family can fully meet your current financial obligations. You can feel secure in your ability to meet your future financial obligations. You have the peace of mind when it comes to the what ifs that life can bring, and we will discuss more of those today. And you have the ability to make financial choices that allow you to enjoy your life. So when we're working with our clients, we're trying to work with them to ensure they have that sense of financial well-being within themselves and in their household. When we look at the elements that make up your money, we're earning, so we have our income, we're being taxed on that, maybe the large deductions from your payslip, money is transferred to our bank accounts and we spend that. That's where some people excel. So that's the banking and budgeting. We would look to protect our lifestyles through the protections that we have, our personal protections. We look to maybe save or invest some of that money for the short, medium and long term. We might look to pay off our mortgages or take out some borrowings. At some stage, we'll want to cease working. We'll be planning for retirement, but we should be planning for older age as well. So again, when we're working with our clients, they are the areas or the elements of your mind that we are giving assistance and advice on. So today is about protecting against the what ifs or the financial curveballs that life might bring to us. So what are they? Well, to start with, you might have too little income coming into your household versus the expenditures. Okay, so too little coming in versus too much going out. There might be an accident, okay, or an illness that would prevent you or your partner from working and therefore earning the incomes that you're currently earning. There might be an illness of somebody else in your household, and what would be the implications for that? Okay, what if there was a change in your incomes? Okay, or there was a collapse in your savings? What about the risk of outliving your money? Okay, what about the death of somebody, leaving others in the dark, either the lack of information being shared between the spouses? And ultimately, what other curveballs might you think of for your household? So when we look at the various curveballs, number one, what if there's too little income versus too much expenditure for a household? So again, when we're working with our clients, we will always try to ensure that they have a proper understanding of how much comes in per month versus the outgoing. So first of all, trying to understand on a monthly basis what comes into a household, because for some households that might not be easy to account for based on the pay cycles coming into that household. So obviously if you're paid monthly, yes, you can determine that quite easily. If you're paid 4 weekly, well, then there's 13 paychecks over the course of the year, so you multiply by 13, divide by 12. If you're married maybe to a teacher or a nurse, they might be paid fortnightly, so their income we multiply by 26, their fortnightly income, multiply that by 26, divide by 12. And someone that's paid weekly, multiply by 52 and divide by 12. So we try and get a common denominator between incomes versus outgoings, okay? And there might be other incomes that will come into the household over the course of the year, like bonuses, share dividends, for example. But in order to maintain a set amount of income per month, you would take the regular income. So for example, a bonus payment might be annual. So you wouldn't account for that in your normal monthly income calculation. Once you do that, then again, we use a common denominator for assessing incomes versus expenditures, and we use monthly. Knowing the amount of incomes that comes into a household, it's fantastic when it comes to cash flow modeling, because you can plan ahead the incomes into your households versus your expenses. So this is an excerpt from our cash flow modeling, where we look at the expenditures for a household from now all the way until life expectancy, age 90. So all that red is the expenses that this household, this dummy client of ours, would expect to have over the course of the next 40 and 50 years. When we look at that, then we can overlay the incomes into the household between now into their working career also into retirement. And we're looking for areas of red, i.e. that's deficit of incomes over expenditures. So we can say to these clients for the Australian trip that they're planning, they haven't saved enough for that, but also in this phase of education for their two boys, that their current method of saving will not be enough to pay for the education of their boys living away from home. Retirement doesn't look too bad. There isn't that much right here, and that can all be adjusted for anyway. So it's very important to understand the incomes and outgoings uh, for every household from a cash flow modeling perspective, but also for yourselves, just understanding where your money is going. We would say having an accurate spending plan for your household is very, very important. So the spending plan is available from our website. It's at olismoney.ie. It's in the knowledge corner. It's an Excel file. And from that, then you can input the monthly incomes for your household. So we've calculated here the monthly incomes of the household. And then we look at the various expenditures for the household to determine, is there a surplus or a deficit? Okay. What can we change? Okay, can we increase the incomes coming into your household if there's a deficit? Can we try and rent a room and we avail of the rent room relief, 14,000 euros tax free? Can we do additional hours of work or maybe get some additional incomes? Okay. Have you checked the tax credits in your standard rate cutoff point from your tax perspective to ensure that you are claiming everything that's available to you to claim? Your tax is typically the largest deduction on your payslip, but not enough people know or understand how that tax is actually calculated. When it comes to your expenditures, have you looked at your expenditures to see where your money is actually going? Are you paying for high credit cards, for example? Okay, high interest. Could you actually clear that from savings money that you have already in a deposit account, earning 0% interest? Okay, so that's something to be aware of. Could you look at your utilities, for example, based on the rate of inflation at the moment? We should all be comparing our utilities, the cost that we're spending on the utilities, with the comparisons like bonkers.ie or consumerhelp.ie. Okay, so trying to ensure that if there is a deficit in income over expenditure, can we increase the income or reduce the expenditures? Okay, so every household should be working off, I would say, an accurate spending plan. It's designed to be a spending plan, not a budget. It's a spending plan. The second curveball, what if there was an accident within your household? Is there a fire or an accident? So are you properly insured for rebuilding? So we would always advise clients to check the Society of Chartered Surveyors of Ireland. They have an annual guide to rebuilding costs. So you should ensure that your home is properly insured from a rebuilding perspective. So you can check on the SCSI website if you have a 3 or 4 bed semi-D or a bungalow in the vicinity where you're living, the rebuilding costs for that type of property. If you have a car accident, are you properly insured for that? Okay, are you on third-party insurance at the moment? Would comprehensive be more advantageous to you? So you need to think about, what about if the eventualities happened? What have you got at the moment? Is that what you want? And then take action to address that. If there was a medical need in your household, okay, do you have adequate health insurance to ensure that you can get speedy health care for your family and family members? So again, another independent website to use is the Health Insurance Authority website, where you can compare various health insurers versus the other and the various plans they have. It can be mind-boggling because there are thousands of actual plans in the open market. So what I would always advise is, when it comes to private healthcare, is to ensure that the private hospitals that you're most likely to go to are covered in your area by the plan that you're looking for. Okay. If there's an accident or an illness, well, are we properly insured against that? The Irish Cancer Society had their 2020 results published late last year, and they said that the average additional cost for a cancer diagnosis is about 756 euros per month. Okay, with many patients facing increased outgoings of 1,000 euros per month, and cancer patients have an average drop in income of 1,500 euros. So there's a big swing there for a household if they're diagnosed with an illness. Okay, so are you properly insured against that? This is just a kind of an overview of a serious illness claimant that we had last year. And as you'll see, we were delighted when we got this letter from Irish Life to say that 147,000 was being transferred to their bank account because they were properly insured for an illness. Okay, are you properly insured for an illness? What would be impacted in your household if you were diagnosed with an illness? Would your income stop? or would it be reduced dramatically? For how long would it be stopped or reduced for? Is your income protected? Okay. Would any of your expenses change? Obviously, your commuting costs may go down if you're no longer traveling to work, but you might need increased childcare. Obviously, your medication would increase. So these are things that you should consider as well. What would be the impact to me and to my household if I or my spouse were diagnosed with a serious illness? Okay. What will be impacted? Your savings, obviously, yes. If your income is impacted, you will be depleting your savings. What type of emergency fund have you? How long will that last? Okay. What insurances have you to offset any accident or illness? Will some of all of your mortgage be paid off in the event of a diagnosis of a serious illness? What cover have you? Are you insured? Is the largest debt that you have insured against a serious illness? If not, okay, I think it would be prudent to check what you have. What would you want to happen in the event of a diagnosis? And how can you then insure against that? If your partner had an illness, so for example, if you're the main employer, if you're main employee and earning, if your partner had a serious illness, would that, what impact would that have on your household? Sometimes we forget about our partners. There may be a home carer, or maybe not earning, not the primary earner, but it would have a significant impact on your household, I would imagine. Okay. The cash flow modeling perspective, when we look at what will be the impact, you see there's more red here if an income was to be eliminated or reduced significantly in the event of a diagnosis of a serious illness. You see all that red there. So the previous one was somebody was employed. This one here now is somebody has an illness, their income is significantly reduced, and this person has income protection, for example, but there's still a deficit, as you'll see there. So what would happen to your household in the event of one of you was unable to work due to long-term illness or disability? What would happen? What would you like to happen? And then, therefore, what are you insured for? Okay. And who's paying for that insurance? Is it you or your employer? Okay. If there was an illness for somebody else in your household, what's the impact of that? Okay. Would you need to take time off work to care for that relative? If it was a brother, a sister, a mum, or a dad who needed your help or care, your income, would you need to take time off work? How long would you be able to avail of that? Time off, having a significantly reduced income. What expenses would therefore increase? Okay, maybe commuting costs. Commuting costs would increase if you're traveling up and down the countryside. Do you need to make adjustments to the home? Okay, for example, making it wheelchair accessible or renovating a downstairs bedroom. Okay, would we need to factor in long-term care costs? Again, for somebody else in the household, okay, what insurances does the person for whom you are caring, have they any serious illness? Have they income protection? Have they any sick cover? Okay, your savings, again, if you're taking time off work to care for somebody else in your household, how does that impact you in the event that you want to take time off to care for maybe a mum or a dad who have been diagnosed with something and you want to be there for them? Have you planned for that, or should you be planning for that now in the event that that may be something that could happen in the future? What has it changed to your income? Okay, have you sufficient rainy day funds to care for that? We would say that you should have at least 3 to 6 months of net monthly income set aside for this eventuality of a rainy day or an emergency fund. You don't need 12 months, you don't need any more than that, but 6 to 12 to set aside as an emergency. You don't touch that unless an emergency arises. Have you that type of savings set aside? Okay, if not, you should be striving for at least 3 to 6. So whether it's 3 or 6 depends on the level of insurances you have put in place to cover for a drop in income or the diagnosis of serious illness. Obviously, if you're well insured, maybe 3 months is more than sufficient. If you're not well insured, I would be striving for at least 6 months of net income set aside as an emergency fund. Okay, if an emergency did strike, okay, what flexibility have you with loan repayments, your mortgage? Can you take maybe some skip months on the repayment? Can you go interest only? These are things I would say would be worthwhile knowing, at least knowing, or having the option to assess what would happen. Again, if you change your income, what would happen in terms of expenses, commuting costs, childcare, medication, okay, and for how long? So these are things that we can plan for, okay. But it all starts with understanding where are we currently, what have we got, and where do we need to get to, and then planning to address the deficits there. If there is a shortfall or collapse in our savings, where what should we be striving for? Okay, so we would say that with a well-constructed spending plan, that should be backed up by a feeder account to cover all of your monthly outgoings, okay, and your annual expenses. And annual expenses are obviously expenses that arise over the course of the year, but they're not there every month. So, for example, Christmas, your car tax and insurance, the annual big holiday. So these are expenses over the course of the year we know will arise, but they're just not there every month. But we should be able to budget for that. So if, for example, you download the spending plan from our website and you complete your annual expenses, if that total is 18,000 for the year, well, we should be setting aside 1,500 euros per month to cover those expenses as they rise over the course of the year. Then we have our emergency account. We just cover that. Again, I think from 3 to 6 months should be set aside there. If we're people who change the car every 3 to 5 years, maybe we would save for that as opposed to borrow all the time. Maybe we're planning a holiday of a lifetime in the next in that medium term. Maybe we should be saving for that. And there will be things that will happen over the longer term. For example, children's education. If you have a maybe 2 or 3-year-old infant now, you shouldn't be saving your money in a deposit account, earning most likely 0%. So a short-term savings product would be used for short-term, for example, like a car. If we have a long-term savings requirement like education or retirement, we should be using long-term savings products, okay, like educational savings funds or pensions, okay, for those long-term savings products. So key points to remember, okay, is to mitigate risk based on what are we saving our money for and when it might be needed. Just like I mentioned, short-term savings requirements, therefore we need short-term type products. Long-term savings requirements, we would use long-term savings products. So we're matching the potential return and the duration of the savings requirement. Another risk is, well, what if we were to outlive our money? Okay, so we're going from the cradle to the grave. And this is where if somebody's planning maybe to retire at 60, well, life expectancy is closer to 90. So these people would have a 30-year, time horizon then. So it's a long time to plan our money for. Are we saving enough for the retirement that you are looking for? And that's something individual to every household. What type of a retirement am I looking for? Well, it's typically based on the standard of living that you're enjoying today is determined by your income that you're earning today. And if you're retiring on a Friday, on an income of 6,000 or 7,000 euros a month into the household, well, that's the standard of living that you enjoy. On the Monday when you retire, you want the same standard of living, but your income is going to be significantly less than that 7,000 or 8,000 coming in. So we need to plan for that. And we plan by starting early. We're saving for our retirement early in our working careers, and then we can manage risk and return. The earlier you start to save for retirement or any long-term savings goal, well, then the less risk you need to take. Okay, a pension is effectively a magic product because we avail of tax-free money paying in, which is tax relief. Up to 40% of every contribution is paid in tax relief. There's tax-free growth while you're paying in. There's tax-free money when you retire, and you can take up to 200,000 euros of your pension fund tax-free or capped at 25%, one or the other. And then if you don't reach retirement, there's tax-free benefits between spouses. Okay, so it's a fantastic pension, fantastic product to have when we are saving for a long-term requirement, like long-term retirement. Okay. So people say to me, oh, I don't really believe in pensions. I think we'll save money in a deposit account. That's a crazy position to be in. So pensions are a fantastic, fantastic product for retirement income. What if you died? Obviously, that's a significant curveball and a significant what if. What if we died? What is the impact of that? So, for example, if I died in the morning, okay, yes, my income would stop. Okay, what is it then replaced for my wife and my children? Okay, my wife will get the widow's pension. What else? Okay, with 2 children. What about our household expenses? Would they change? Well, obviously, any expenses relating to me, to my personal spending, would stop. If Trish died, my wife, what expenses would stop for her, and what expenses would therefore be increased for me? Will there be more childcare? So got to think of the impact of death. What insurances do we have? Okay, would our mortgage be gone in the event of either of our deaths? And what other lump sums would be paid to our family? Have we death in service? What other benefits would we have? So when it comes to death, are the above insurances, enough to last the family the length of time they're needed? If not, we need to do something about that. So in effect, when we're planning for death, every household should have significant insurance that would be paid to maintain the same standard of living until your youngest child is effectively financially independent after they finish third level education. And we would say that is around age 25. So there's a calculation that we would perform for clients to determine how much money comes in currently in the event of each member being alive. One of those dies, how much income would stop coming in and where that income replaced from. So social welfare, mortgage being paid off, what's the deficit, how many months until our youngest child is age 25, when we can insure for that figure, deduct in any death in service or any insurance we have, and the deficit is what we actually insure for. But leaving others in the dark, and this can be quite common in some of the households and the clients we deal with. You might have, maybe the husband, for example, might be the person who kind of knows the stuff about money. But if that individual was to die, are we leaving, the spouse in the dark when it comes to the managing the finances of the household? Are we operating from joint accounts or single accounts? Obviously, if all of the money is held in a single name savings account and that person died, access to that is going to take a little bit of time until the death cert and all the formalities are done with there. So we would always advise to have accounts in joint names, savings in joint names, so that it's easily accessible in the event of a premature death. Okay, and to share knowledge about what's happening in the household. Okay, we don't want to leave anyone in the dark. Make sure that you have a will done. Okay, and your intentions are known, because that is important to make sure it's up to date. If your employer has a letter of wishes, that you have that completed, so you're effectively notifying your employer as to who you want the death in service or the benefits of your pension fund to be paid to. Okay. Have you an enduring power of attorney? If, for example, you had a stroke and you couldn't make a decision for yourself, if you had a mental incapacity, have you an enduring power of attorney? It should be, it should be an integral part of your, long-term care. Okay, and have you an advanced healthcare directive? So that's something that when you're talking to your solicitor, you should not just talking about a will, but you should be talking about all three of those: enduring power of attorney, an advanced healthcare directive, and a will. So they should all be working in tandem with each other. So conversation is key. Knowledge sharing is so vital when it comes to maintaining financial well-being. It's easier to plan for these eventualities than it is, than in haste or not at all. So if someone passes away and you have no knowledge of what's going on, well, then it's too late. So it's easy to have conversations and to work through all of those. So finally, well, what other curveballs might there be? So every household might think of something that might be relevant to them. Okay. All we try to do is give you a flavor of some of the curveballs that when we're talking to our clients about, we try and help them to mitigate by planning for them. First of all, understanding where are you today? Where would you, understand the risks that might be there, or the what ifs, or the curveballs. If one of those were to actually play out, how are you positioned right now to deal with that and to maintain a sense of financial well-being in your household? If there's an issue, then you have time to address that and get that addressed. Okay. If we can help in any way, we're more than delighted to help. I would say if anybody wants a copy of the spending plan, it's on our website, oulismoney.ie. In the knowledge corner, you can go to the archives and it's there in the December section there. Okay. Thank you for watching the webinar. I hope you found it of use, and thank you. Take care.